This is Nightly Business Report with Bill Griffith and Sue Herrera.
Rally fizzles, stocks soared at the opening bell, but the optimism faded as investors have a hard time making sense of this market.
Softer stance. The president's crackdown on Chinese tech investments was less harsh than expected, but questions about the economic impact remain.
Labor setback. The Supreme Court deals a blow to unions in a decision that could have far-reaching implications. Those stories and more tonight on Nightly Business Report for Wednesday, June 27th.
And we do bid you good evening, everybody. Call it the moody market. Stocks soared out of the gate this morning on word that the Trump administration had decided not to limit or block investment in U.S.-based tech companies that had substantial Chinese ownership. But the morning's euphoria did not last long, and for whatever reason, around midday, technology and financial stocks suddenly turned lower and turned this rally upside down. By the close, the Dow had a gain of 285 points midday, but by the close, it was down much more than that. A loss of 165 points to 24,117. The NASDAQ was down 116. That's where the technology stocks live. And the S&P 500 fell by 23. Bob Pisani has more on today's topsy-turvy day.
Stocks started the day strong, but the rally fizzled out with the Dow whipsawing in a 350-point trading range. Traders are having a tough time making sense of what I call the yo-yo stock market. The White House backing off some of those harsh measures to restrict Chinese investments in the U.S. That did help prop up stocks early on. But the reality is trade issues and a potential trade war, they're far from over. Tech stocks wasted no time in rolling over. So semiconductor names that would be influenced by trade wars like NVIDIA, Applied Materials, they fell 2 to 3% on the day. Defensive sector like utilities, consumer staples, they all closed higher. Bank stocks haven't budged. The XLF, which is a big basket of financials, down 13 days in a row. That's a record. Goldman Sachs, Morgan Stanley, they're down 20% from their recent highs. They're in bear market territory. These banks are getting hammered by fears of a flattening yield curve as short-term interest rates continue to inch higher. Energy did provide some relief today. Oil was over $72. But remember, oil is a much smaller sector than banks and technology. Finally, we're coming up on the end of the month and, of course, the end of the second quarter. So pension funds and other groups are likely moving around a lot of money. They're having to rebalance their holdings, some of them, and lighten up on certain stocks that have raced higher all year, especially technology. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And by the way, today's strange market was just another example of what has been an unusual year for stocks. Mike Santoli has more on that a little later in the program. Sue?
Bill, the initial spike in stocks followed the Trump administration's decision, as we mentioned, to soften its stance towards Chinese tech investment in the U.S. Many investors viewed that as a de-escalation of tensions between the world's first and second largest economies. Kayla Tausche has more on the latest White House position on trade.
President Trump decided to expand an existing tool to review foreign deals in the U.S. instead of writing new rules just for China.
We're working with China now, and I think hopefully that'll get straightened out.
The move marks a significant de-escalation in the trade fight with Beijing. House lawmakers passed a bill Tuesday that gives the Treasury more power to review inbound investments that might pose a risk to national security. Commerce is now studying outbound transactions. Treasury Secretary Steven Mnuchin says China will not be singled out.
We're going to treat China the way we're going to treat other people, and to the extent that we were worried about transactions, we will block them. But we are not going to, on a wholesale basis, discriminate against China as part of a negotiation.
It's a hard right turn from the White House's recent approach to China, announcing tariffs on up to $450 billion in goods just 2 weeks ago as trade tensions heated up. The president's economic advisor, Larry Kudlow, told reporters today there is communication between the two countries, and today's move should solve the problem. For Nightly Business Report, I'm Kayla Tausche in Washington.
So what exactly is the existing review process that the president plans to use when making some key trade-related decisions? Michelle Caruso-Cabrera takes a look for that tonight.
Investors who are worried about a trade war got some good news today. The White House announcing that it will use its current tools with some enhancements that have bipartisan support in Congress to restrict Chinese investments that they think threaten national security. This legislation amplifies the mandate of an organization called CFIUS, which stands for the Committee on Foreign Investments in the United States. Up until now, CFIUS was narrowly focused on foreign buyers of U.S. companies with a focus on protecting U.S. technology. In the past, CFIUS has rejected several tech deals, including Broadcom's attempt to purchase U.S. semiconductor maker Qualcomm and a bid for Lattice Semiconductor from a group of Chinese investors. Now, among other things, the administration can also look at joint ventures, both here in the United States and overseas. The Treasury Secretary is always the head of CFIUS, and today he said China will be singled out simply because the U.S. has a very large trade deficit with that country. There's wide bipartisan support for this legislation. Just yesterday, the House voted 400-2 in its favor. For Nightly Business Report, Michelle Caruso Cabrera.
So what is the potential impact of today's announcement and the ongoing trade back and forth on the economy? And what happens if we make it harder for countries to buy our goods? Diane Swonk is the chief economist with Grant Thornton, and she joins us from Chicago. Always good to see you, Diane. Welcome back.
Thank you. Good to be here.
I guess it must be hard to model this economically because there are so many changes. The positions are changing as they work through the system in Washington. But net, what do you think?
Well, I do think this is a good first move. Unfortunately, we know we don't have a lot of staffing at Treasury, so we don't know what the staffing will be. We already know the issue of trying to get exclusions for the steel tariffs. There's 21,000 applications where some companies only get a foreign kind of steel that is no longer made in the United States, and they've not been able to get through the bureaucracy of commerce because there's no staffing. And so I think part of the uncertainty out there is you can say that you're de-escalating, but it may not make a difference in terms of what the real outcome is, because the decisions may be consolidated down to too few people with too little information, and we still don't know what that means.
But at the same time, globally, we're now starting to see a domino effect, Diane. Canada and the EU both fear Chinese will dump their steel there that they would have dumped here in the United States. They want to impose tariffs. Where's this going, do you think?
Well, this escalation, it's interesting because many people sort of said, oh, well, good, they're all finally getting some coordinated efforts. And I do think it is good to have a coordinated global effort to deal with China. That said, some of the problems with both European steel and Canadian steel is that it was coming through and getting into the U.S. without the tariffs, before the tariffs were on, and being dumped here by going via different routes. And so the idea was, how do they delineate it once it gets there? And so even though they're putting tariffs on it, it's a bit of a way more to protect, hopefully to de-escalate with the United States and have the United States take the tariffs off. I think one of the problems is you see we would like this to sort of be an end to problems and a drop in tariffs. Unfortunately, I think we're going to see much more tit for tat, and this is more like a bad divorce where people keep upping the ante and hurting each other, and at the end they're both losing money and they're hurting their kids. So I just, there's not a real easy, clean way to get out of a situation like this where you start escalation.
And so if that is indeed the case, when do we start to see the impact on some of the monthly and quarterly reports that we get from the government?
Well, the good news is the U.S. economy is so strong right now, we've not seen a lot of impact, although we have begun to see it in things like the PPI, which is accelerated quite dramatically. We've also heard the Commerce Secretary comment about how we've gotten ahead of ourselves. The prices of steel and aluminum are already running very, very high. They're 50% higher in the United States than our competitors now on steel, 80% higher on aluminum. And that's because we've got markets front-running the fears of tariffs. And this is what more tariffs down the road. And this is where I think the complication comes is when I try to model it, you get very small incremental effects, you get inflationary effects, you erode some purchasing power, but you don't get the full-out recession until you start adding all these additional things that are hard to get your hands around modeling.
Well, it's a good thing you get to do that and we don't. We'll talk to you again soon, Diane. Thank you very much. Diane Swonk in Chicago.
Speaking of the economy, the trade deficit in goods narrowed in May. According to the government's so-called advanced report, the deficit stood at nearly $65 billion. That's well below what was expected, around $69 billion. The trade gap in goods excludes services, and the advanced report is viewed as an accurate reflection of trade patterns because the services sector does not change much month to month.
And orders for long-lasting goods fell for the second straight month. Softer demand for cars and aircraft sent durable goods orders in May down 0.6%. Despite the decline, though, the result was better than economists had expected.
Potential home buyers took a step back from the pricey and competitive housing market last month. Fewer contracts to buy existing homes were signed, and that sent pending home sales down 0.5%. The expectation was actually for a gain. Sales have now fallen on an annualized basis for 5 straight months.
Raising interest rates too quickly is a major risk to the economy, so says the president of the St. Louis Fed. James Bullard told the Wall Street Journal that aggressive monetary policy could pose a problem, adding that he is trying to push against faster rate hikes.
And oil prices rallied today to their highest level since 2014 on supply concerns. A report from the government today showed that crude inventories notched their biggest weekly decline of the year so far. Some traders are also concerned about threats to sanction countries that do not stop importing oil from Iran by November. The price of domestic crude settled above $72 a barrel today.
The Supreme Court today issued its final decision of the current term. The ruling was a blow to labor unions that could result in a loss of members and money. Eamon Javers reports tonight from the Supreme Court.
A significant decision today and a blow to public employee unions in the case of Janus versus AFSCME. This is a case that's all about whether public employee unions have the right to require non-members who work for that public sector entity to pay union dues, even though they might not want to. Mark Janus, an Illinois state employee, decided he didn't want to pay about $45 a month out of his paycheck for that union and decided to take that case all the way to the Supreme Court. Today, the Supreme Court siding with Mark Janus. The court deciding that 1977 precedent doesn't apply anymore, saying, "We conclude that public sector agency shop arrangements violate the First Amendment, and Abood erred in concluding otherwise." The court also going on to sympathize with the unions who will suffer an enormous loss of revenue potentially as non-members decide not to pay those union dues. They say, "We recognize that the loss of payments from non-members may cause unions to experience unpleasant transition costs in the short term and may require unions to make adjustments in order to attract and retain members. But we must weigh these disadvantages against the considerable windfall that unions have received under Abood for the past 41 years. Ultimately, the Supreme Court here saying Abood was wrongly decided and is now overruled. So a significant victory here for federal employees who don't want to join a union and don't want to pay union dues, and a defeat now for federal employee unions. For Nightly Business Report, I'm Eamon Javers at the Supreme Court.
And also at the Supreme Court, Justice Anthony Kennedy announced plans to retire, giving President Trump a chance to reshape the High Court. Kennedy was the swing vote on a number of key decisions and authored landmark rulings on gay rights, the death penalty, and campaign finance.
Time to take a look at some of today's upgrades and downgrades. And we begin tonight with General Electric, which was upgraded to perform from underperform at Oppenheimer. The analyst there cited the company's plan to spin off segments, which we reported yesterday. The firm also says that GE's strategy could unlock value and diminish liabilities. The stock rose more than 1.5% today. It closed at $13.96. Meanwhile, Yum Brands was upgraded to buy from neutral at BTIG. The analyst cited recent stock weakness and the potential benefits from its investment in Grubhub. Price target now $92. That stock fell more than 1% to $78.87.
Teva Pharmaceuticals is being added to Citi's U.S. focus list. The analyst cites a favorable risk-reward profile and the prospects for increased earnings. The price target is $27. The stock rose a fraction to $23.64. Bank of America raising its price target on Netflix to $460. The analyst is predicting that Netflix will reach 360 million subscribers by the year 2030. The firm maintains its buy rating on the stock. Despite the price target, though, the stock fell 2% to $390.39.
Still ahead, sticker shock. Why Toyota is warning that the price of every vehicle it sells here in the U.S. could rise.
The Justice Department has approved Disney's proposed $71 billion acquisition of 21st Century Fox's assets. The deal does come with some strings. Disney has to sell off 21st Century Fox's 22 regional sports networks as a condition for the green light. Disney has been locked in a battle with Comcast over those assets, and Comcast has reportedly been exploring partnerships with private equity firms just in case it needs to raise some cash for a possible higher bid. Comcast is the parent company of CNBC, which produces this program. Today, 21st Century Fox rose, while Disney and Comcast were down on the day.
First, it was North Korea's Kim Jong-un, and now it is Vladimir Putin. The White House announced today that President Trump will meet with the Russian leader in a one-on-one summit in an attempt to work on relations between the two countries. The exact date and location is expected to be announced sometime tomorrow.
Toyota has a warning for investors, consumers, and the White House. The automaker today said that a 25% tariff on automobiles would increase the cost of every vehicle sold in the U.S. Now, that echoes a statement from the auto industry that we told you about yesterday. The Alliance of Auto Manufacturers, which includes both American and foreign automakers, says a trade war will lead to widespread job cuts and price spikes in showrooms. Phil LeBeau has more.
Ready for sticker shock? The auto industry says 25% tariffs on imported vehicles will lead to buyers paying a lot more. The average price will jump about $5,800, according to automakers. They warn sales will plunge by up to 2 million vehicles, which could ultimately lead the industry to cut 195,000 jobs.
This will unleash, if it comes about, a real trade war because the numbers are just so much bigger.
For the auto industry, tariffs could kill one of the longest, most successful periods it's ever experienced. GM and Fiat Chrysler have gone from bankruptcy to record profits. And auto manufacturing jobs in the U.S. have rebounded to pre-recession levels, thanks in part to a record number of autos being exported. Still, President Trump wants Europe and China to lower tariffs on the models being shipped overseas, or the 7 million cars and trucks being imported to the U.S. could be slapped with hefty tariffs.
It'll raise prices dramatically for consumers in the United States. It will be inflationary. Ultimately, it will slow down sales.
Right now, those buying a new car or truck are paying on average just over $32,000. Which brings up the question, how much more would Americans be willing to pay for a particular model if the price suddenly spiked due to a border tax? A couple $1,000s? $5,000? It's a guessing game the auto industry is hoping it won't have to play. Phil LeBeau, Nightly Business Report, Chicago.
General Mills is cutting jobs, and that's where we begin tonight's market focus. The maker of Cheerios cereal said that it's going to eliminate more than 600 jobs by next spring as it looks to cut costs, while sales of its Yoplait yogurt continue to struggle. The company did report an increase in overall sales in its fiscal fourth quarter, but earnings fell. And General Mills did give upbeat guidance for the next fiscal year in 2019. Still, shares fell by 33 cents to $45.73. Delta said that rising jet fuel prices are likely to add about $2 billion in its expenses this year. A few weeks ago, the airline slashed its second quarter profit outlook, blaming rising fuel costs. Today, shares lost altitude, if you will, falling more than 2% to $49.89. And we told you last night that the companies were in advanced talks, and today Conagra did indeed confirm that it is buying Pinnacle Foods for just about $11 billion. The deal between Healthy Choice owner Conagra and Birdseye parent Pinnacle creates the nation's second largest frozen foods company behind only Nestle. But the announcement clearly left a bad taste in shareholders' mouths. Conagra was down 7% to $35.45. Pinnacle was off 4% to $64.95. Susan.
Bill, shares of World Wrestling Entertainment took off after announcing new multi-million-dollar TV deals with two networks. The 5-year deals to air the company's flagship wrestling shows are with Comcast's NBC Universal and 21st Century Fox's Fox Sports. And there are more than triple the size of WWE's current contracts. WWE's shares were up more than 6% to $70.85. And after the bell, Bed Bath & Beyond said earnings beat Wall Street expectations. Same-store sales did not. Same-store sales fell more than 0.5% in the quarter, while the street was looking for a slight gain. Shares initially fell after hours, wiping out a fractional gain from the regular session, where they closed at $20.18.
So here we are nearly halfway through 2018, and the year so far on Wall Street has been anything but usual. Mike Santoli takes a look now at what has been a strange year for stocks.
The stock market this year has taken an extraordinary route toward a pretty routine destination. First, the extraordinary part. In the first 3 weeks of 2018, the S&P 500 rushed to its best January in 31 years. Then it suffered the fastest 10% drop from an all-time high in 90 years. This dramatic reversal has been followed by an unusually long and labored recovery process, which has lasted nearly 4 months and has so far recouped a bit more than half of the wintertime tumble. Yet with all that drama, the S&P is sitting on a slight gain for the year, and with dividends is on pace to deliver an annual return somewhere around 6%, just short of the market's long-term yearly average. And that's after a gain of some 20% in 2017. Perhaps the market's modest progress has seemed like more of a struggle because the economic and corporate news has been so good and hasn't been fully embraced by investors. Corporate earnings are on pace to grow 20%, and U.S. GDP has a good chance to expand at a 4% annual rate this quarter. Restraining stocks from reflecting such a positive backdrop, rising interest rates, threats of an all-out trade war, a sharp slowdown in overseas economies, and fears that this year's growth could represent a tax cut sugar high, followed by a rude payback in 2019. There's also some unease about how uneven the market action has been. Only two major industry sectors, technology and consumer discretionary, have appreciably outperformed the broad market, and stock markets in the rest of the world have lagged badly. If there's good news in the U.S. market's muted performance in the first half of this year, it's the way stock valuations have come down from lofty January extremes. With few leading signs of recession visible, this period could be seen as a helpful reset in valuation and investor expectations that could help extend the life of the bull market, even if it feels a bit less exciting and more treacherous than it did just 5 months ago. For Nightly Business Report, I'm Mike Santold.
Coming up, can a quintessential American brand ride out a political storm?
In Kansas City, Missouri, I'm Morgan Brennan. It's an American icon in the crosshairs of the bigger global trade debate. We look at the rough road for Harley-Davidson, coming up on Nightly Business Report.
Listen to this. A six-figure salary in San Francisco is now considered low income. That's according to new figures from the Department of Housing and Urban Development. The threshold to qualify for low-income assistance for a family of four is now $117,000, the highest in the nation. And in May, the median home price in the Bay Area hit a record $935,000.
Lyft is beefing up to better compete with the likes of Uber. The ride-hailing company has now raised $600 million in new money from investors. And get this, that now values that company at $15 billion. That is double the value from just a year ago. Uber, as you know, plans to go public sometime next year, but Lyft's IPO plans, they are less certain right now.
Harley-Davidson has come under fire from President Trump after announcing plans to move some production overseas. One plant in Kansas City is set to close this year, with union reps saying plant operations will move to Thailand, a move that so far Harley has denied. Our Morgan Brennan went there for us today.
Harley-Davidson is a rare company. They produce a truly iconic American product, largely made in America, that global consumers want to buy. When the EU wanted to retaliate against U.S. tariffs on metals, they slapped a tariff on Harley's imported motorcycles from the U.S. because it's an American icon. Now Harley's announcing it will move some manufacturing abroad due to those tariffs. The decision drew the ire of President Trump, including a tweet today to criticize the move. Harley-Davidson should stay 100% in America with the people that got you your success. I've done so much for you, and then this. The news has pressured shares of Harley this week and stoked reaction from other officials as well, including Treasury Secretary Steve Mnuchin.
I listened to the president talk about tariffs on motorcycles, and he's been a big advocate of Harley-Davidson and American products. So I don't know why Harley-Davidson would come out and now say they're moving production. We've been fighting to lower their tariffs all over the world.
Harley's troubles started before this trade spat. Sales in the U.S. have plunged as Harley's core riders, baby boomers, have gotten older and as newer generations haven't shared the same zeal. So it set sights abroad to help spur a turnaround. It's also added manufacturing in markets where demand is growing: Brazil, India, and later this year, Thailand. Meantime, here in Kansas City, the factory behind me is scheduled to close next year due to the need to consolidate amid those falling U.S. sales. 800 employees work here, and some of those operations will be shifted to Pennsylvania, but only 400 jobs will be added there. Employees here are sorry to see the work and the Harley-Davidson name leave town.
It's an American icon, you know, we're supposed to be built here and everything, and so really we should just continue, you know, regardless of how much money they can save, because you know what, when you're number one, that's all that counts.
Harley-Davidson tells us that the closing of the Kansas City plant and the opening in Thailand are not related, and that the production shift overseas is simply to avoid tariffs imposed by the EU on motorcycles it sells specifically into that market. Regardless of why the moves to produce more overseas have manifested, for hundreds of employees here, the closure of this plant will mean not working for an American icon that's long been beloved. For Nightly Business Report, I'm Morgan Brennan in Kansas City, Missouri.
And before we go and look at the topsy-turvy day on Wall Street one more time, a 285-point gain in the morning turned into a 165-point decline for the Dow in the afternoon. The Nasdaq was down 116, the S&P down 23.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. We'll see you tomorrow.